So we started going from the C class up to the B class properties, and now we're continuing to kind of double down on that effort of going towards A class, like B plus A properties, mainly just on vintage versus luxury and designer finishes. It's more so on, we want something like 2015 or newer. Various reasons, insurance being one of the reasons, things like that as well. We can get into why we made that pivot, but going forward, our buy box, as we call it, is going to be about 150 units, 2015 or newer, good amenities, good floor plans, good layouts, good unit mix in the DFW market is what we're looking for. And that puts us around the $20 to $30 million range for a purchase price.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Vince Gethings. Vince is the co-founder of Tri-City Equity Group and the owner of Wheelbarrow Profits Academy. And in just a minute, we're going to speak with Vince about multifamily investing 2025 pivots. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Vince Gethings. Welcome to CREPN Radio.
Thanks, Darren. Glad to be back on.
Yeah, no, little backstory there. We tried this once before, and the weather wasn't cooperating. So hopefully we've got some clear skies today. But
I'm excited.
Yeah. Well, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share a little bit about your background.
Yeah, absolutely. So I've been investing in real estate since 2013. I started with my VA home loan. I was active duty military. Did what we call a house hack on that from 2013 to 2016, where you buy the crappiest house in a decent area, VA home loan, fix it up while you live in it, and sell it for the profit, tax-free profits on the back end. So we did that in 2013 to 2016. Taking that capital, I wanted to buy more real estate. So then I started buying duplexes and fourplexes from 2016 to 2018. And from there, I decided that I wanted to get to the next level. I hit a ceiling with the smaller properties, and I wanted to how to get to that next level of bigger properties, the real commercial real estate. So 2018, I joined a coaching mentorship group, and I got everything I need to know from them and started getting into multifamily. So since 2018 was the start of Tri-City Equity Group. We've transacted over 100 million. Currently, the portfolio is about 100 million too as well right now, and probably about 1,400 units, and maybe 1,500, somewhere around there. And down here in Texas now, focused on the DFW market.
Got it. So your start, you mentioned you were in the military. Were you moving around? Was that, or were you able to stay in kind of one area, or how was that?
No, I moved around, being active duty, and I was in the Air Force. Every 3 to 4 years, we moved around. So that was an important part of how I was going to invest, my strategy for investing, knowing that every couple of years I was going to move around. So was very interesting, but we got through it.
Got it. So you've I don't say graduated, but you've progressed to multifamily, 1,400 units. That's not a small portfolio. Um, have you had a specific strategy with that? Have you continued to kind of value add, or have you done any new construction, or what has been your model?
Absolutely. So we started with C. It's a lot of people start mainly for the cost of doing higher class assets. So C class value adds is where we started for Tri City. I believe we did probably like 16 of those. Eight of them have gone full cycle um, of the C class value add repositions. Um, Going in from, we decided that we wanted to start going after higher quality assets. So we started going from the C class up to the B class properties, and now we're continuing to kind of double down on that effort of going towards A class, like B plus A properties, mainly just on vintage versus uh, luxury and designer finishes. It's more so on, we want something like 2015 or newer. Various reasons, insurance being one of the reasons, things like that as well. We can get into why we made that pivot. But going forward, our buy box, as we call it, is going to be about 150 units, 2015 or newer, good amenities, good floor plans, good layouts, good unit mix in the DFW market is what we're looking for. And that puts us around the 20 to $30 million range for a purchase price.
Got it. And you mentioned insurance as one of the criteria that helped you focus on newer. Were there any other factors, or I mean, the C class to the moving towards the A class? Can you
Mm-hmm.
shed some light on your thinking there?
No, absolutely. So we went through COVID, and I had a bunch of C class properties, during COVID, and then I had like one or two B class properties. So that's why 2022 was that year we made the pivot, because at the end of 2022, we're kind of sitting looking at the performance of the year, and a couple of things kind of stuck out at us is like the C class property struggled, a lot more than what we were expecting. Usually C class is pretty recession resistant. But we noticed that with that black swan event like that, and all the workforce was not allowed to go to work. The C class ones got crushed, at least in a lot of the markets that we were in. And then we had the eviction moratoriums and everything like that. So going through having the income hit on the C class stuff during that time, as well as now we have properties that are 40, 50, 60 years old. And now we have huge capital expense bills coming as well on those properties. And the amount of time those properties require to maintain certain occupancies and collections, and or ultimately our economic occupancy. It required a significant amount more of time and effort to maintain those higher levels, 90% and up, than our B class property, A class property. So that was what we discovered, and it wasn't really even a close call. It was like the amount of time and effort we spent on the B and A's versus the C's. It was like the C's were significantly more amount of time and effort, and while our income was going down and things like that. So we wanted to make the pivot. Additionally, all of us in Tri-City all have our other companies as well. So, I have a couple service-based companies I run. My partner has a couple service-based or gyms and stuff like that he runs, and they produce a lot of our cash flow. So when we're weighing that into it as well, so we wanted to we decided maybe it was like 1 or 2 point difference when we were modeling out difference between a B and a C in this market. I was like, we'll take a 1 or 2 point hit on returns for a significant amount of our time and effort and stress and downside risk to be removed. And that's where we decided to go in 2022. And so since then, we've been targeting newer class assets. The last one we just bought was like a 2021 We have one under contract that's a 2023, and the returns are not that much different in this market. When we hit different market cycles, there that it can expand in between it. But right now, it's like you can get really, really good deals on higher quality assets in this market that we're in. So we're going to double down on that effort.
Got it. See, clearly the age of the property is, identifiable. When you started, you talked about, you'd been in the duplexes and the fourplexes. How large of properties were you buying when you first started buying apartments?
Our first one was a 52 unit in
Okay.
2019, and after that, the next four were around that 50, 60 unit range. We didn't break 100 until probably like our sixth or seventh property.
Got it. Got it. And you said your focus going forward is kind of 150 plus?
Yep. Well, 150 plus or minus. So we can go, down to 100 if it's, if the numbers make sense. But mainly, it's not much a number count that matters to us. It's the amount of payroll that property can support, so we can hire on-site property managers and maintenance. That as the asset manager, that's my key metric, is the property needs to be able to support a full-time staff on site.
Got it. So that's interesting. As you mentioned, the unit count. Have you found a sweet spot that or is 150-ish? Is that kind of where you
Yeah,
really
that
see
is
the?
kind of the sweet spot for us that we've
Okay.
seen. We've also gone vertically integrated as well in 2023. So we brought our property management in-house. Once we decided that we were going to invest solely in the Texas market, and sell everything else that was in, we were in 4 or 5 different states. So once we decided we were going to sell everything else that wasn't in Texas, we found it was a great time to go, as we call it, vertically integrated, and bring property management in-house. So we started a company called Black Sand Property Management and started taking our properties in-house. So that gives us a really good pulse on what it costs to actually run units. And we can shave off 20% of operating, the variable operating expenses, just by operating more efficiently, and we've done that. So that's pretty exciting. And for us, around that 120, 150 is kind of the a good number for us, because it 3 people can run that property: a manager, a leasing agent, and a maintenance tech. If it's an older property, you're going to need probably 2 maintenance techs, because now it's older, it's going to have more work orders. But if we're going for newer properties, one qualified maintenance tech can usually handle it.
No, I appreciate you sharing that, because that's always been, or I hadn't really thought of it in terms like that. But when you said it, that it supports it, that makes a lot of sense. And you said 20% savings. Is that just the difference between in-house and subbing out the cost? Is that what you see?
It is, but it's not as like straight line of like, oh well, they're going to charge us 5%, we're going to do it for 3. There's our savings. It's more so when you have third-party property managers, no matter how good intentioned they may be, it's not their money and it's not their asset, and they don't care. And I've gone through, and I say that from probably 6 or 7 different third-party property management companies that I've hired for my assets, and dozens of managers that I've had to manage over the years. It's, they might be great people and everything like that, but at the end of the day, it's not their asset, not their money. They don't have any skin in the game. So that savings is coming from, yes, we do it in-house for 3%. And third parties might be doing it for 4 or 5, 6, 7, whatever percent, however their structure is. But most of that savings is actually coming from being good stewards of our money, and not wasting money on frivolous things that aren't needed. When it comes to repairs, make sure we get 3 bids, make sure we're looking at it, with a keen eye, to make sure we're not just hitting the easy button and just paying the bill, swiping the card because it's easy. And on marketing and admin expenses, like, we don't need to spend $1,200 at Office Max every week on whatever they've been buying from Office Max, So there's stuff like that where it's just like you look down your chart of accounts and when you get your income statement and you're like all these different buckets where just money just kind of just goes through the sieve and just disappears and never actually makes it to the NOI line. And so once we took over, we realized like it was like very quickly, and our bookkeeper and controller brought it to us. It's like, wow, like we didn't really make any extra revenue this year. We're talking 2024, and so at the end of this year, so this is fairly fresh. And it's like we didn't really make any extra revenue because rents are flat, for the majority of Texas in 2024, and even declining in some markets. But our NOI across the board has increased, and it's specifically because we're not wasting money with our in-house property management. Because last year was our first full year, 365 days of property management, and so she was very happy to report that. So it does, it did show in the bottom line, and our investors were happy for that. But it is a lot of work. It's not something that I want to like sugarcoat. Property management is a lot of work. You're in the trenches a lot, but once that system is built, get a couple good people in place, and then again with us looking at it from the asset management standpoint, I'm trying to reduce expenses and increase NOI. But now we have in-house property management and have that experience. Now I can go back and modify our buy box to say the best way for us to grow is to pick assets that can support payroll. Because the easy thing to do is start spreading your property managers thin. And we've done that and we burn them out very quickly. So having the in-house property management gave us the data to make better decisions on the asset management side and acquisition side. And that's kind of how we backed into that buy box of newer properties and needs to be able to support a payroll, its own payroll.
Yeah, I mean, makes sound sense. I was kind of curious because I've managed my own properties. I mean, small single family stuff, and then I've hired property managers, and kind of that whole theme of it's not their money. It just plays out all the way up and down. But I'm curious, do you find also that just the time, kind of the understanding the value of time when it's in-house as opposed to third party, specifically to like turns, knowing that you've got somebody who's going to move out on Friday, you don't wait till, Monday to call the guy to see what's going to take. And, 2 weeks later he shows up, and 2 weeks later it's, still not complete. I'm like, good God, this thing should have been, speed dial. We got somebody moving out on Friday. We need to hear Monday.
Yeah, and that's we have what's called our tenant journey that resident journey that we built out in our CRM, and that includes the move in and the move out. And our move out and turn process actually start the second they put in notice. So for us, as soon as they put in notice, either voluntary or involuntary, we get in there and we tour that unit, and they start putting together a list of things we need to order. And 2 weeks or whatever it is before they move out, we already know what that unit needs: is paint, flooring, whatever, cabinets, and we already know what to have on order. They move out, we get possession, and everything is already kind of staged, ready to go for that unit, and our contractors can go, right away.
Yeah, that right there, that to me is just, that's keeping your eye on the ball, and understanding that you're going to spend the money regardless, whether you wait 2 weeks or you do it the minute you get the keys. But just to have that ready, set, go mentality, and then also be able to, get somebody new in there faster, as opposed to some sort of delay. So, and do you feel like did that reality, did that help to your bottom line as well, or was it more just like the loose kind of the spending that was more contributing to the lower NOI with the third party?
The immediate fix was the spending. We were able to see that almost immediately, of just not wasting money on nonsense. The other things as far as the unit turns, or let's just call it just the vacancy loss, for whatever reason, either collections or taking unit turns taking forever. That one is a little bit harder, because now we have to have the systems and processes in place and have the people trained and bandwidth to do it. So as a new property management company, that one took a lot longer to set up. I think our vacancy or delinquency systems and eviction filing and all that is really dialed in. We don't carry a lot of bad debt across our portfolio. The unit turns are a lot better. Always room for improvement. I think with scale, another way we look at building the property management company is every acquisition we buy, we take this payroll, say 100 unit can support $200,000 a year in payroll. Well, some of that's going to be on site, but then some of that can go toward like a big, pool of payroll for the company, for like overhead and things like that. So as we're building our company, we have a couple key positions that as we start bolting on new assets, we can bring in those positions. One of them is like, for example, a marketing manager for our portfolio. We're still kind of outsourcing a lot of our marketing. I'd like to have that in-house and have, somebody just running our marketing, but we have to hit some scale to do that. But we have that position, that seat identified. Another one is a unit turn coordinator, where all they focus on is just unit turns across the portfolio. And that's separate than maintenance. Because right now we have our maintenance guys that are trained to do unit turns as well. But there's, we run into some bandwidth issues at some point. If they get 6 or 7 work orders a day, the unit turn has to wait. So we're still more efficient than we were before, but we could be better. And that's the area that we know we can better, is have the maintenance guys focus on the work orders, and then have an entire unit turn like division almost in the company that all they do is just go around and do unit turns. But we're probably one more acquisition away from being able to have that team fully standalone.
No, makes sense. So tell me, you mentioned investors. Are you guys syndicating the properties?
We do what is best for the deal, I guess is a better way to say it. So if the deal is a large deal, good returns, and say like over 5 million that we need to put down, we'll probably syndicate that. If it's a smaller deal or some creative financing structure and we only need 5 million or less, we'll probably do a JV on that. So it's less a strategy for us. It's more of what tool is the best for that job. And I have a lot of tools in my toolbox. So sometimes it's a syndication, sometimes it's a JV, sometimes it's a seller financing, master lease option. I have a lot of ways I can take down deals. So right now we have a syndication selling on Thursday, and we have one acquisition buying on a JV. So it's we don't just do one thing. It's just whatever tool is the best for that job.
So on the difference between the syndication and the JV, are any of the investors in one category also investors in the other?
For the JV, mostly it's our core team, and then if there is, we might bring on like 1 or 2 investors that we've known for a long time, and usually because they can put down a significant amount of the downstroke on the down payment. But usually it's just our core team.
Got it. And then you still have your management company across all your properties.
Correct.
Got it.
And another reason for the JV too is if we find something that we want to hold for longer than your typical 3 to 5 years that a syndication life cycle is, that's another reason why we want to push for the JV structure versus a syndication. Because syndications, a lot of those investors want their money back. It's a velocity play mostly, so they want their money back 3 to 5 years. If we find something that's brand new construction, 2023, 24 construction, and it's in a growing part of the market, we're going to try to take that down possibly as a joint venture and hold it for 10 years. So we're going to pick, us and maybe pick 1 or 2 of our, investors and say, hey, we're going to buy this thing and hold it for 10 years under a JV versus a syndication.
Right. And with that, on your syndication, what's your typical hold time?
3 to 5 years.
3 to 5.
I
Okay.
think across our portfolio, we do have a slide on this somewhere. It's like it's either like 3.7 or 4.2 is kind of like our average hold time.
Yeah. Between 3 and 5. That's good.
Yep.
So, all right. We titled this episode kind of the pivots for 2025. You've made um, mention of many of the changes that you guys have made over the course of your investing history here. Um, are there any that are specific that are new, uh, looking forward 2025 and beyond that
Um,
are,
yeah, I can kind of summarize the ones as we evolved from 22 to 25 because we've had made a couple, but they're all complementary. So the first one was going a mile deep versus a mile wide. When we built Tri City, I said actually I did say I was going to circle back to this. So when I was in the military, all my partners were in the military. We founded the company in Hawaii, so we were already out of the market as well. So I was an out of state investor in Hawaii, California, and Hawaii, investing in the mainland. So what that did was it allowed us to go wide in our markets. So we picked 4 or 5 markets, and we were just going wherever the deals were, and we were able to scale very quickly. The issue with that is when you go wide, it's really hard to manage. You hit a your capacity and kind of critical mass there very quickly. And for us, it took us about 2 to 3 years and 5 different states to realize that I became the bottleneck. That was 5 different states of state laws I needed to manage to kind of learn, and landlord tenant rules and all this stuff, and taxes in each state, and 5 different property managers and dozens of contractors across the country. So it became very cumbersome to manage. So in 2022, we also decided to go from a mile wide to a mile deep. We picked one market, the one that we just thought had the most potential in it, and that ended up being Texas. So that was kind of the first pivot, was going from a mile wide to a mile deep. The second one was looking at our portfolio, and this was shortly after that. Of like, okay, what type of assets do we want to go after? We have been doing C class value adds, and we noticed that our B class was, even though we paid more, our B and A's, even though we paid more per door, actually was producing better, safer returns from our investors through like kind of the volatility the last couple of years, which was kind of contradictory to all the books and all the courses out there. It's like, usually it's supposed to be the C class that has the kind of that stability, but it wasn't that way right now. So the second pivot was going from C class to the B's and A's. And then the third one was going for the size of the asset, going up above that 100 unit mark, specifically because we wanted to scale the property management company, and we want to have the property be able to manage its own payroll and be able to afford high quality property managers. And those are expensive. So the property needs to be big enough to be able to afford the quality property managers and maintenance techs. So going big enough to be able to support that. So those are the pivots that we've made kind of back to back to back over the last year. And then as we get into 2025 here, I moved down here now. So I'm in the DFW market, and we're just going to continue to grow and scale Tri-City along with our Black Sand Property Management Company.
yeah, I think those all make a lot of sense. And just that mile deep thing, I think people don't always appreciate that. Um, how being in the market and knowing the market and being more familiar with even the difference between streets and
Yep.
boundaries
Makes a
and
huge
just
difference.
the territory. Yeah, it really does. So let me ask you about just the last kind of pre-COVID to now. Uh, the market was frothy. There was lots and lots of deals. Interest rates were low.
Mhm.
Money. The cost of money drives a lot of the market. Since then, the cost of money has increased. Seems to have stabilized, but still just, the mindset takes a little while to adjust. What are you seeing is the finance, options that you have now? and just kind of the structure of the, the financing as opposed to what you were doing, say 2022, 2021?
The last few deals we've done have been loan assumptions, largely because we know that the cost of money is expensive. I think the lowest I've recently got quoted was a 6.6 on community bank debt, so 25-year AM debt, and that was the lowest I've gotten. Everybody else was, in the sevens. A lot of banks switched to like prime, like a prime plus. So you're already, well into the sevens for interest rates. So we've been looking for distressed sellers that have agency debt that is assumable, with a good amount of time left on it. So that has given us interest rates and terms in like the 3 to 4% range, because we're assuming their debt. We're competitive at that when they come to market, because it's usually low leverage. So that eliminates a lot of our competition. And low leverage, I mean, like we're putting down like 40 to 50% plus working capital, plus CapEx, and all the plus closing costs. So we're putting down a significantly more than if your typical new debt at 70-80% LTV. So that's given us a little bit of a competitive advantage that we're okay and comfortable putting more down. Our cash flow is obviously way better, and we sleep good at night knowing that we're low leverage. And again, it only hits a couple points in like the returns to be able to have that much more security. Going through these markets right now, this volatility, I'd rather take 1 or 2 points less in percentages to have a 50% LTV loan, or up to 60% LTV loan, and I can sleep good at night, knowing that we can weather a lot of storms. And it's proved to be a good business strategy, because a lot of people that have higher leverage debt are struggling right now. They are doing capital calls. They are, forcing, having to force sales because their debt's ballooning and they can't refinance. And we're there to, buy a lot of these assets at discounts. But the mainly the last couple of deals have been agency. Yeah, like we did the last one. I'm trying to think here. We think the last one was HUD at like 63% LTV. And then the one before that, I think, was Fannie, around the same, like 55-60%. So that's mainly what we've been doing, and for our acquisitions and our debt.
What's kind of a minimum runway you look for as far as what's remaining on the debt?
Definitely 5 years. So if it's under 5 years, I definitely don't feel comfortable with it, because I want to be able to. I don't like to model refinances in any of my scenarios, because you have no idea what's going to happen. As we've seen, what's causing a lot of the turmoil in this market right now, and it's still happening, is people that have debt coming due, and they might be coming off a 4% loan into an 8% loan, and I guarantee they didn't underwrite for that. So, and nothing against them. Nobody knew we were going to get here. So, but yeah, at least I want to be able to have at least enough term to go through my entire business plan, which is that 5 year, that 3 to 5 year.
Yeah, no, that's beautiful. So let me ask you, on the ones that you see that are blowing up, where they're forced to refi, or not forced to, their loans coming due.
Yep.
Um, have you seen any of those or worked any of those on your spreadsheets to see how I guess what I'm trying to figure out is the property trading at a price where if you had to put new debt on it, it's working, or is it going into foreclosure? I mean, what's the?
I'll give you a couple scenarios of the typical deals we see right now in this market. So context for listeners, I don't know where everybody's from, but this is from my experience in Texas in 2025. So what I'm seeing is a lot of the third-party property managers. So we'll start from I'll walk down the P&L as I see this. So a lot of the property managers they were on the gravy train, from COVID up to about 2022. There was money flying around. They didn't have to go work for leases. They didn't have to go work for rent increases. They didn't have to go work for collections at the end of 2022. And that, like, so now we're into 23, and is kind of when the music stopped, and 24 as well, was the property managers actually had to, the tide went out, as Warren Buffett would say, and all the property managers that grew really, really fast were not equipped to actually manage, go knock on doors, go out there and get leases, go out there and get collections. And that was kind of the start that I see, and it happened to us. That's why we started our own property management company. Is I was just cycling through property managers, and they kept subpar performance. So that's kind of what I saw from on the top line of the revenue, is that the property managers, the good ones, we're still out there, but the vast majority got complacent, got comfortable, or grew really fast, and they were putting people on properties that weren't trained to actually do the hard part of the job. And so we saw that. On the expense side, variable expenses are pretty much in line, at least in our portfolio. There has been a huge increase in variable expenses. Marketing is up, but other than that, everything else is fairly stable for us. The fixed expenses is where everyone is getting slaughtered. And again, specifically in Texas and probably Florida too, is taxes and insurance. We did our books for 2024, and for context of slaughtered, is our taxes went up 53% from the start of some of these acquisitions in 2021, 2022 to now to 2024. It was 53% increase in taxes, and our insurance was like 110% up. And I don't care how good you are at managing, you can't manage your way out of 110% increase in insurance. And so that is, again, being sympathetic to a lot of these deals that are in trouble. Probably, a lot of them are good guys. There's some bad apples out there that kind of spoil it, but you get hit with that. And then a little bit more on the insurance market is like a lot of the insurers just moved out. They're like, they canceled policy. Sorry, we're no longer in this market, or we're no longer in this asset class. And, we're just left kind of scrambling. So the insurance increases, and hopefully I'm started hearing that Florida's starting to come down. So I'm hoping that Texas follows, and, we get back into some reality on our insurance rates. But when it comes to the fixed expenses of the tax insurance, that is something that is causing a lot of turmoil in a lot of these groups. And that is driving down the NOI. The debt is still high. The cost of money, we're still in the 6-7%. So we have that cap rate expansion of what, where these deals make sense. Those cap rates that we were buying at probably 4 to 5% are now, those deals are penciling out to hit the debt service coverage ratios that we need at 6-7% to make the same deal work. So some sellers are there either because they bought before 2020 and they have the equity, or they're there because they have no choice and they have to sell because their debt is ballooning, and they're in some kind of pre-foreclosure or something like that. Those are the deals that I'm kind of seeing actually on the market, where the buyers and sellers are able to get close enough to make a deal. Everybody else is just holding out. We have deals that we want to sell that I paid $155 a door for. That's probably worth $130 a door for now, because the cap rate's expanded, and we just have to hold it. Good thing is we're in a good position, and we can weather that storm because we put the right debt in place, and we bought it right. Oh, we bought it right for the market. We financed it right, and we're managing it right. But now we just have to kind of weather that storm. So there's a lot of people that are out there just weathering the storm, and they want to transact, but they can afford to hold it. But all the deals we're seeing on the market are the ones that thought by now, mid 2025, that the markets were going to recover, the rates were going to come down, the liquidity was going to come back to the market, and it's just not there. So they're kind of at the end of their waiting period that they can wait, and they're forced to transact. So that's kind of a lot of what we're seeing now. Or they've owned it for a long time and they have so much equity that it doesn't matter. Taking a 20% hit is just not significant to them.
Yeah. Well, like you said about the insurance, hopefully the financing continues to improve, but I think as it stabilizes, eventually the market, if your financing's coming up, you're forced to do something. It's either refi or sell.
Mhm.
Those are basically the options, and that naturally just kind of forces the market to do something. So
Mhm.
there are some interesting factors that are involved that are going to force the hands. But no, I appreciate you sharing all that. Hey, Vince, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your investors, the interest rates, the market projections, the Fed, local jurisdictions, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Vince Gethings, what is the biggest risk?
From what I've seen, it'd probably be over leverage. I know it's kind of the easy answer, but a lot of the issues that I've seen of people, being forced, their hand is forced to take action, is because they're in an over leveraged position, and they don't have they don't have the working capital, they don't have the liquidity to kind of weather the storm, so they're being forced to take action. Where a lot of kind of more seasoned investors are sitting on their hands right now, and they can afford to do so, and they're not being forced to buy or sell. So that is what I see right now as far as the biggest risk are the people that we had the survive to 25 mantra all in the last 2 years, and that's not working. So maybe it's survive to 26, survive to 27, but um, I think that could have been a lot of that could have been prevented if just keeping leverage in check. And yeah, that's probably the biggest one. I can probably go half a dozen more, but that's the one I'm going to go with.
Yeah, it's hard to see those interest rates changing so fast. When the market's happening
Oh yeah.
and all your models are based on cheap money and quick turns and we're going to be in and we're going to be out or refi or whatever that is. But
Mm-hmm.
yeah, it's kind of funny. Not funny. It's interesting to look back just on such a short timeline to see how dramatically it changed.
Yeah, well,
And
while you're in it, yeah, like you said, it's hard to see while you're in it, and that, but
yeah,
looking back, it's like, wow, I shouldn't have taken out that 90% LTC, bridge loan. That was dumb, and
yeah,
rate, and but
yeah.
at the time, it's what,
Made the deal work.
yeah.
Yeah, yeah, I get it. Hey, Vince, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. So I am on social media, YouTube and Meta and all those things, LinkedIn. I do have a couple free giveaways if you're a guest like that. You can reach out to me at Vince at wheelbarrowprofits.com, and I can shoot over that, put in the show notes, but drop me a line there and I'll give you, we have a couple free books and a couple free templates, due diligence checklists and things like that that we use in our company that I can provide to anybody that's listening.
That'd be great. Well, Vince Gethings, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I learned a lot, and I look forward to doing it again soon.
Absolutely. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.